Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Bloomberg sources say senior US officials are preparing for a possible strike on Iran in the coming days. President Trump says he's keeping his options open. Higher prices are coming. The Fed leaves interest rates unchanged, but warns some of the impact of tariffs will fall on the US consumer. Plus, rate decisions from the Bank of England and the Swiss National Bank. Today, we bring you the previews and the analysis. Good morning. Happy Thursday. So will he or won't he? That is a key question for the markets when it comes to Trump's decision as to whether or not the US should intervene against Iran alongside Israel. That question still being debated, it seems, within Washington. And we watch, of course, the geopolitics and the decision making from the US president. European futures are down by 0.3%. It's been a challenging session for Asia as well, with the MSCI Asia Pacific down, the last time I checked, a little over 1%. FTSE 100 futures in focus with the BOE decision, of course. That central bank remaining on hold. That is the expectations. What we hear in terms of the balance, of course, of the risks in terms of the inflation and softer growth in the UK. FTSE 100 futures called up by 0.1%. S&P E-minis, the US is closed for a national holiday, so you're pointing to the reopening on Friday. US futures currently down 0.1% after a flat close, essentially, by the end of play on Wednesday. Nasdaq 100 futures pointing lower by 49 points. Let's flip the board and have a look cross asset. The Fed decision, of course, to stay on hold. Not a big surprise, but Jay Powell suggesting that tariffs will lead to higher prices for consumers. It forecasts as well around inflation and growth. Higher inflation, those are the forecasts adjusted higher, and growth forecasts adjusted lower. The dot plots, the forecasts coming through, still expecting 2 cuts by the end of this year, though there is a split amongst the FOMC. That's a picture across the MSCI Asia Pacific right now. The losses are there on the geopolitics, on the Middle East, down 1%. The pound at 134. We watch, of course, this currency as we build up to the BOE's decision, currently down 0.1% on a little bit of strength coming through for the greenback. Brent remains volatile on the Middle East. $76 a barrel on Brent, down 0.2% so far in the session. And gold getting a little bit of a lift. The safe haven up 0.2% at 3,375. So Bloomberg understands that senior US officials are preparing for a possible strike on Iran, potentially within the next few days, with signs that the infrastructure needed to join Israel's offensive is being gathered in the region. The US president declined to confirm whether Washington's involvement is imminent.
You don't seriously think I'm going to answer that question? Will you strike the Iranian nuclear component? And what time exactly, sir? Sir, would you strike it? Would you please inform us so we can be there and watch? I mean, you don't know that I'm going to even do it. You don't know. I may do it. I may not do it. I mean, nobody knows what I'm going to do.
Well, let's bring in Bloomberg's Germana Pesecci, of course, who's been following all of this for us. Germana, the US potentially looking to get involved. They're putting in place the possibilities to do that in terms of the infrastructure, in terms of the planning. The optionality clearly is there for the Pentagon and for the US president. Is it now a question of when?
That appears to be the case per our reporting. Bloomberg article overnight, we have spoken to senior officials within the Trump administration who have said that they are preparing plans to get involved militarily in the coming days. That is a direct quote. But they've also said that the plans are fluid and the plans are still evolving. One White House official saying that still all options remain on the table. But one thing that is for sure, Tom, is in the past couple of days, what we have seen is a hardening of President Trump's stance towards the region. It was not that long ago, earlier on in the week, he was perhaps still pushing for the diplomatic channel, the possibility of bringing Iran back to the table again on the nuclear discussions. But as you know, if we put together everything he said, from warning and demanding that Iran go for an unconditional surrender, warning that he knows where the Ayatollah is hiding, but that they've spared him for now, so an implicit threat in that one. But then also being asked about what he was going to do directly by a reporter, saying, I may do it, I may not do it. all options are on the table, but that the final decision will be made 1 second before it's due. It doesn't lead to a lot of the ambiguity around the situation being lifted. Now, on the Israeli side, they have said that they have independently managed to eliminate a lot of Iran's defense capabilities already. They continue with their strikes on key military and nuclear sites in Iran. They have said, and this is according to two officials that Bloomberg has spoken to, that they are not officially asking the U.S. to join, but if the U.S. do join, it would be welcome because it would allow them to continue on with their strikes against some of those key nuclear enrichment facilities. The main one that we've been talking about is Fordo, buried deeply underground and can only really be struck at in a serious manner if the U.S. get involved militarily with some of their large munitions, the bunker busters that are necessary to do so. So it looks as though we are entering into a crucial couple of days ahead. But again, still unclear when the U.S. are going to get involved. If they do get involved, however, there are the infrastructure plans in place.
Yeah, they're certainly giving themselves that optionality, it seems. Iran and the supreme leader there, they've been delivering an address, the Iran's supreme leader, a video address. What has the Iranian response been?
Yes, a televised video message came out from the Ayatollah, the supreme leader, yesterday afternoon. Words of defiance. He was saying that if the U.S. want them to surrender unconditionally, they will not capitulate. He says that they will strike back. And if the U.S. are seen to be joining Israel in bombarding the country, they predict irreparable damage. That is the exact language that was used. They will stand firm against an imposed war, just as they will stand firm against an imposed peace. They also responded later on in the day to comments that President Trump made, suggesting that Iran had asked for a meeting at the White House. The Iranian official at the UN actually put out a post on Twitter, on X, saying no Iranian official has ever asked to grovel at the gates of the White House. So dispelling the notion that they have actually reached out to speak to the U.S. diplomatically. So again, a lot of ambiguity, fighting words from Iran, U.S. looking to get involved militarily. Overnight, the strikes continue. The severity of the attacks leveled at Israel from Iran has started to diminish in the last couple of days, possibly in anticipation of a larger strike that could happen over the next few days if the U.S. do get involved.
OK, the decision-making, it seems, within Washington still on a knife edge. Bloomberg's Germana Pasecci with that crucial update out of the region. Thank you. To monetary policy now, switching focus. Federal Reserve policymakers voting then unanimously to hold interest rates steady for their fourth consecutive meeting. Not a surprise, of course. Fed Chair Jerome Powell says there are lots of unknowns about the outlook for the economy, including the impact of U.S. tariffs.
The amount of the tariff effects, the size of the tariff effects, their duration and the time it will take are all highly uncertain. So that is why we think the appropriate thing to do is to hold where we are as we learn more. And we think our policy stance is in a good place where we're well positioned to react to incoming developments.
OK, let's get more now from Bloomberg's Valerie Teitzel. So, Val, staying on hold, of course, as expected, the Fed, the dot plots as well, confirming the market views that there's going to be two additional cuts, or at least two cuts in 2025. So confirming the market pricing. So any surprises?
Look, there was really little surprises, little market reaction. The one thing that did stand out to me was a change in the first line of the statement, saying that uncertainty around the economic outlook has declined, perhaps giving a nod to the fact that, yes, there's still a lot of uncertainty around tariffs, but trade policy uncertainty has very much fallen since their previous meeting. And so, to me, hey, we're past peak uncertainty, even though they still talk about how much uncertainty there still is remaining. They released their new economic projections. These are the first ones since the announcement of Trump's tariff plan on April 2nd. They revised down growth, revised up inflation. So for the remainder of the year, the PCE inflation and core PCE inflation now has a 3 handle on it for year end 2025. They also revised up the unemployment rate. The dot plot was kept the same. But I would note, Tom, that there were a fair few members of the FOMC who are now penciling in no cuts for 2025. So while the median still stayed at 2 cuts cuts for the year. There's now 7 members thinking that there should be no cuts for the remainder of 2025. Previously, it was 4. So there does seem to be a growing group of FOMC officials that think the Fed will be on hold through the remainder of the year. Powell did downplay the dot plot. He downplayed the projections, saying that no one holds these rate paths with a lot of conviction. So not a lot of conviction for anyone on the FOMC when it comes to the outlook for the U.S. economy. But he emphasized again and again that monetary policy is well suited to handle the uncertainty ahead. He was a bit more hawkish when it came to the labor market. He still characterized the labor market as solid, Tom, which I think surprised many. Many thought that he would drop that kind of language given the moderation in payroll growth of the last few months. He did mention that it would take a very long time in order to delineate from tariff-induced inflation that will be a one-off or perhaps understanding if tariff-induced inflation will lead to higher inflation expectations and maybe something they need to react to. That will take some time for the FOMC to decide.
OK, as you say, the split within the FOMC is intriguing, isn't it, with those 7 officials not expecting any cuts this year. So they would join Jay Powell in terms of potentially hiring the US president. He responded rather predictably with a post on Truth Social describing Jay Powell as, quote, a dummy and, quote, as the worst. So President Trump clearly keeping up that campaign, that pressure campaign for Jay Powell and the FOMC to move faster in terms of rate cuts. What has the market reaction been to the decision making and the steering that we're getting from the Fed at this point?
The pricing for the remainder of 2025 stayed pretty steady over the course of the press conference, Tom. The market is still expecting a 70% chance of a rate cut around September, and again is expecting one more in between September and the remainder of the year. S&P 500 was pretty stable over the course of the press conference, as well as the Bloomberg Dollar Spot Index. So not a lot of surprises to hang our hat on, but the market, I guess, is more convinced about the pricing for 2 cuts for the remainder of the year.
OK. Val, thank you very much indeed. Bloomberg's Valerie Teitel, who stayed up late, of course, to watch the press conference and digest what was coming through from the Fed and the adjustments in terms of inflation and growth forecasts and, of course, the dot plots as well with the market reaction. Val, thank you. To another central bank now, because the Bank of England is expected also to keep interest rates on hold later today as inflation here in the UK remains stubbornly elevated. Officials are also contending with a cooling economy and rising oil prices as Middle East tensions escalate. Let's get more with Bloomberg's Lale Akoner then, who's giving us a preview of what to expect from the BOE. So the data out of the UK has softened when it comes to the growth picture. The jobs picture is looking a little weaker as well, and yet prices remain relatively elevated, as we said. How much of a challenge is this for the BOE?
Well, it is quite a tricky mix. As you say, we've got growth, coming in for April, quite disappointing. We've also saw yesterday CPI figures showing that they do remain elevated. And we've had a loosening in the jobs market, firms cutting jobs the most since the pandemic. So it is a difficult balance to manage just on a domestic front. But then, of course, you've got all of these macro concerns as well. We talked a bit about tariffs just now, and that perhaps is, we've passed peak uncertainty, as Valerie said, but there's still a lot of uncertainty baked in. In fact, one of the problems for the UK economy we saw was that exports to the US fell by the most on record last month. So that still, is playing out. There is a trade deal, of course, which will mitigate some of that impact. But there's still a lot of global uncertainty, which can impact inflation. And then, of course, the most recent development is the situation in the Middle East, which we've seen oil prices spiking already on. But really, I think there's so much uncertainty there that is something the Bank of England are going to be having to take into account today. And I would expect to see them discussing uncertainty to some extent.
And partly why they're likely to hold today in terms of rates at 4.25%. What is the consensus amongst economists, or at least our internal team as well, as to the direction of travel for rates from the BOE? They hold today, but what does the picture look like through the rest of this year?
Well, yes, the economists are unanimously expecting rates to be kept on hold today, and that is very much what the market is pricing in as well. Looking ahead, the market is leaning towards a cut in August, and at the next meeting, and then looking at probably one more before the end of the year. But the market has been paring back on those bets. really over the last week, and that means that there is some uncertainty there as well. Yeah. I think in terms of the forward guidance, what we'll really be looking for is probably going to be a reiteration of that gradual and careful rate cutting progression, but perhaps the fine details might indicate some shift there, which we'll be looking for very carefully in terms of, is there a slightly more dovish tilt? Are they slightly more concerned about the risks to growth, or is that inflation risk looming larger?
OK, Morwenna, thank you very much indeed, with a preview of what to expect from the BOE and what to focus in on as well. Bloomberg's Morwenna Coniam. Here's what else to be thinking about today then. Another central bank action as well. At 8:30 a.m. UK time, the Swiss National Bank will come through with that rate decision. They could move rates to 0% for the first time on record. And at 9 a.m. UK time, the Norges Bank as well coming through with the rate decision. A big day for central banks, a big week for central banks. It's Juneteenth, so US markets are closed, US equity and Treasury markets are closed for that US national holiday. Just a reminder on that front. Coming up, BYD accelerates into Europe as rival automakers struggle to keep pace with the Chinese EV giant. We're going to bring you some of our interview with the BYD's Executive Vice President, Stella Li. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, Chinese EV maker BYD's aggressive push into Europe is seeing results, with sales growing more than 200% in the first 4 months of this year in the region's 5 biggest markets. I spoke to BYD's Executive Vice President, Stella Li, about her investment plans for the continent.
UK is one of the strongest markets, but then also Germany were doing very well, and Spain were super good, and Italy were doing good. In France were doing good. So almost every single a top auto market, BYD performance is outstanding.
You know who's not doing so well in the French market or the German market is Tesla, and they've seen double-digit declines in sales in those markets. Are you filling the gap? Are you seeing customers steering away from Tesla and towards BYD?
Now, we did see our customer came from all different a brand, but very amazing. A lot of brand is a premium brand, then they want to change to BYD. So this is, we did see not only one a brand, but multiple different brand, but is a lot of our customers are really shifting from their premium car to BYD, like a CUDMI, which is the car with a kind of a one charge, one tank of gasoline, can run 1,080 kilometers.
What are you doing differently that Tesla is not doing?
We have more models. So just a very simple example, we have 7 to 9 models. And then we have PHEV, advanced PHEV, BYD called the DMI, is a dual mode intelligent. So if in the daily working life, then it's per charge is 80 to 120 kilometers. So then it's like an EV. But if you want to come to long distance, drive long distance, it's become like a low fuel consumption PHEV. So, for example, our CUDMI now is number 1 sales. Then this one per charge per a tank of gas can run 1,080 kilometers. So this become game changer because this you're going to attract a lot of people who is very stubborn to only trust the ICE car. Now they can have a first baby step to experience electric car. This is which other electric car company did not have.
And that was BYD Executive Vice President Stella Li speaking to me at the Founders Forum here in the UK. And a reminder that tomorrow, Bloomberg Tech Europe debuts at 6:30 a.m. UK on Bloomberg Television. Join me as we spotlight the biggest names and key trends shaping the European tech ecosystem every month. Coming up, LVMH confronts one of the worst crises in its history. We break down the multiple challenges at the luxury giant. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, a 220 billion euro slump in market value. Wow, that is a drop. Is heaping pressure on LVMH founder Bernard Arnault. A widespread luxury slowdown and succession concerns are adding to what one analyst is calling the biggest crisis in the firm's history. It is the subject of today's Big Take, and Charlie Wells is here to walk us through what is going on, the travails at LVMH. What has gone wrong so far, Charlie?
A lot, Tom. So LVMH really has something of a market perception problem. And in the luxury space, this really matters, right? Because perceptions are so important there. But basically, their share price is down by about half from a peak in 2023, and that has created some sort of symbolic problems for this company. So LVMH used to be the most valuable company in France. It is no longer. That would be an issue in and of itself, but what has replaced LVMH at the pinnacle of France is Hermès, which, if we recall, Bernard Arnault tried to acquire in years past. So that is quite symbolic. Also symbolic here, kind of on the back of these slumping shares, is the fact that Bernard Arnault used to be the world's richest person just about a year ago. He used to be richer than Elon Musk. He used to be valued higher than Jeff Bezos, but he has now slipped down that Bloomberg billionaires rich list. He's now sitting, if you go to Rich Go, at number 9. But these are some symbolic changes and difficulties for this company.
What are the missteps then? What have they done wrong?
So look, we got to be fair to them, and the big take is, so the financials of LVMH are pretty strong. There has been a broader slowdown in the luxury space amidst Trump tariffs, amidst a lot of economic uncertainty. Also, China is a really big issue here for the space writ large, not only because of the economic slump, but because of what could actually be a bigger problem, which is maybe a shift in tastes kind of away from high luxury. But some of these problems, as the story goes into, are of LVMH's own doing. And I think one of the big issues here that kind of differentiates LVMH from a lot of the other big luxury houses is how broad this company is. So they have more than 75 different brands across the board. And when times are good, that kind of diversity is, either viewed as good or ignored. But when times start to get a little bit more difficult, there's this issue of a conglomerate discount where the market starts to value the overall company at less than the sum of its parts.
The conglomerate discount. Yeah, that's interesting, isn't it, when it comes to LVMH? What could potentially turn this company around then, briefly, Charlie?
I mean, look, they've got to maybe fix some of these brands, the Dior's and the Moët Hennessy's, dealing with some price issues there, according to analysts. But the big issue is succession. And investors have a lot of questions about this. Arnault has 5 children. The question is, will any of those children take over the company? And also there's a bit of a founder's dilemma here, where Arnault has been involved in this firm for so long. And what we know about founders is that even in difficult times, perhaps it's even most in these difficult times, when they tend to dig in and get the most involved.
Charlie Wells, thank you very much indeed on the Bloomberg Big Take, focused on LVMH. Worth reading, of course, on the Bloomberg terminal and on Bloomberg.com. Coming up, we're going to digest the Fed decision and look ahead to BOE Day with Lale Akoner from eToro. Also thinking about how to position amidst the geopolitical risk. That's coming up. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Bloomberg sources say senior US officials are preparing for a possible strike on Iran in the coming days. President Trump says he's keeping his options open. Higher prices are coming. The Fed leaves interest rates unchanged, but warns some of the impact of tariffs will fall on the US consumer. Plus, rate decisions from the Bank of England and the Swiss National Bank today. We will bring you the previews and the analysis. Let's check in on the markets then. Risk off after some softness yesterday across European markets, and the US market had essentially closed flat. It's a national holiday stateside today, so we await for the open, of course, on Friday. But the futures picture here when it comes to Europe, pointing lower by 0.5%. The decision-making from Trump seems to be on a knife edge as to whether or not the US will involve itself more directly in an attack on Iran. So we watch those developments, of course. The Fed coming through with the hold as expected for the fourth straight time. Interesting that the forecast, the dot plots, still pricing in, still forecasting 2 cuts this year. That was the dot plots. The inflation forecasts and growth forecasts were also adjusted. In terms of the FTSE 100 futures, you're flat as we lead up to that Bank of England decision. S&P E-minis pointing low by 0.2. NASDAQ 100 futures looking to a loss of 66 points. Let's flip the board and have a look cross asset then. Focus, of course, on what is happening in terms of the oil market. The volatility remains pretty pronounced around oil on the Middle East. $77 a barrel now, up 0.4%. So it's shifted again in the session today, just in the last hour on oil. The MSCI Asia Pacific, so you're seeing pressure across Asia, down 1%. The pound in focus at 134, down 0.2%. And gold getting a bit of a lift, up 0.1% on the yellow metal. Now, the Federal Reserve and policymakers voted, as I mentioned, to hold rates again as expected, but say they still see 2 more cuts by the end of this year, or 2 cuts by this year. In updated economic forecast, the FOMC said it expects weaker growth and higher inflation and more unemployment this year. Fed Chair Jerome Powell says the central bank is well positioned to respond.
Despite elevated uncertainty, the economy is in a solid position. We expect a meaningful amount of inflation to arrive in coming months. What's tended to happen is when there's turmoil in the Middle East, you may see a spike in energy prices, but tends to come down. The amount of the tariff effects, the size of the tariff effects, their duration and the time it will take are all highly uncertain. So that is why we think the appropriate thing to do is to hold where we are. The current stance of monetary policy leaves us well positioned to respond in a timely way to economic developments.
OK, with me now is Lale Akoner, Global Market Analyst at eToro. Lale, do we have a clearer picture in terms of the Fed's next steps?
Not really. I think what we didn't learn much from yesterday at all. I think they said that the risks have come down a little bit, but uncertainty is still elevated. Look, we're still thinking that it's a mildly stagflationary environment that they're preparing for. Probably, in our opinion, firms are still going through their inventories, hence we're not seeing any inflationary pressures yet. That will run through most of this summer, but then we expect that the price increases will come next fall as well. So we are pricing in the first cut in September or October, and then one more cut after that. OK, so you align with the views, the dot plots, the forecast. You align with the market views that 2 cuts this year from the Fed. Does the Fed turn more dovish in 2026, and how does the economy evolve? We'll see. I think it's still not certain yet because, as they've said, they don't know those price pressures, whether they will be sustained or not, which sectors will be impacted. I mean, tariff revenues are coming to the Treasury general accounts at the moment. I think on a 3-month basis, they're up 27%. However, no price pressure still. So somebody is taking that on. I think it might hit margins and therefore maybe unemployment as well. It depends. But it looks from the projections that they're moving some of the rate cuts for 2026.
What is your analysis? What is your strategy for working around the Middle East tensions and adjusting to what we're seeing evolving between Iran and Israel?
Positive thing right now is so far the impact in the market is very contained. Obviously, it's impacting oil prices. It's impacting VIX as well. However, what we're saying is that the wild card is Strait of Hormuz. If there's a disclosure there, obviously it's a bigger tail risk scenario that might impact markets and lead to a more risk-averse scenario. But going into this sort of like tensions, we had still spare capacity in OPEC. Iran, I think, produces around 3 million barrels per day of oil, and the spare capacity is 4 million. So it's not structurally tight environment, and hence, if it doesn't seem that an oil price increase will be sustained. And again, the wild card is Strait of Hormuz.
What is the next catalyst for these markets? You see 2 rate cuts. We have an eye clearly on what is happening in the Middle East and whether or not those tensions can ease. Across the markets, the S&P 500 is up a little under 2% year to date. The Stock 600 in Europe has performed better than that, obviously. But there seems to be a bit of a range-bound mood within these markets right now. What's the next catalyst?
First, any trade deal coming from major U.S. trading partners, obviously very positive that we have had one in the UK. We want one from Japan, say India, the major ones. The second is rate cuts coming towards the end of the year, going into second half of the year, and more earnings surprises and positive guidance is what we think will be needed for going forward. And obviously, the fiscal policy is a wild card as well. The House's version is the Senate's version is very different from House's version, and therefore there needs to be some negotiations happening. But there is a hard deadline on the debt ceiling, and that's end of August, and therefore we need to get this done as quickly as possible. I think that will be positive for the markets and might fuel the next rally in the next few weeks.
What's your sector preference at this point? If you had to lean into a particular sector, where would it take you?
I'm still leaning towards more tariff-insulated sectors, mostly in services sectors. We still like value more than growth. We like financials, regional banks, both here in the UK and Europe, but in the US as well, insurers as well. Again, any steepening in the curve will impact their interest margins positively, and therefore we think that there will be good opportunities there as well. And biotech is, I think there are great opportunities, very insulated from tariff and a depreciation in the US dollar, strong cash generation. These are the places that we think are.
We're expecting to get more details in terms of the German spend on infrastructure next week and defence. How do you play that story? Is the window open to still get exposed to the stimulus story out of Germany?
More in the mid-cap, small-cap sectors and tier 2, 3 defence tech suppliers, if you will, rather than the large-cap beneficiaries that already priced in that infrastructure spend. Again, here in Europe, I think there are good opportunities.
The Bank of England is going to be making their decision later today, expected to remain on hold. How are you thinking about UK assets at a time when the data seems to be softening and yet the BOE is still reticent, it seems, to go forward with a cut before maybe September, potentially August, potentially September?
We think they will not cut today. They might wait for August. We are saying that 2 more rate cuts coming this year. We are an energy importer as opposed to the U.S., who's an energy exporter, right? So any sustained oil price increases in the Middle East will impact us, the margins of companies, more than, say, in the U.S. So I do expect the Bank of England to more or less follow the Fed's approach of wait and see whether these tensions will stay elevated and uncertainty will stay elevated before making a decision.
OK, that uncertainty remains for the BOE as it does for the Fed, of course. 4.25 then is what expected in terms of holding rates at 4.25% from the Bank of England. Lale Akoner, thank you very much indeed. Also thinking about some of the sector preferences and next catalysts for these markets. Global market analyst at eToro. 2 more details on central banks now, because the Swiss National Bank is likely to lower its interest rate to 0 today amid persistently slow inflation in Switzerland. Policymakers are also trying to stem flows into the franc, of course, which has gained 8% since President Trump's Liberation Day tariffs. Let's get more with Bloomberg's Swiss economy reporter Bastian Benrath-Wright, who joins me from Zurich. So it's a big day for the SNB and you and the team. What will the SNB do? Are they going to go with 25 basis points, 50? Where are they going to land on rates today?
Good morning, Tom. Good to talk to you. Yeah, this is the wide expectation that they will go with 25 basis points. However, the decision is wider open than is usual for the S&B because there's essentially 3 scenarios. Either they go with what most economists expect, 25 basis point, that would take the rate to 0. Maybe we can talk a little bit later about what is special about that rate, what that means for banks. However, there's 2 other scenarios. Either they could go for 50 basis points. Markets are actually split on the outcome. Traders are betting on 25 basis points, but also on 50 basis points. The pricing is somewhere in the middle between the 2. So that would take the rate into the negative, actually, to minus 0.25. Or they could just leave rates unchanged, which is also possible because some economists have said, well, they were pretty quick with rate cuts in the past, and particularly with a jumbo cut, 50 basis point cut they did in December, which brought the rate down pretty quickly and used up a lot of ammunition. So if policymakers see this point, they could also just leave the rate unchanged, which is not priced at all at markets. So we would, in this case, definitely see the franc go basically through the roof.
Yeah, okay. Well, it's interesting. Some of the analysts quoted in the Bloomberg reporting saying that the idea that you're going to get 50 basis points is more of a London trading desk view rather than the domestic view in Switzerland. What if we get to zero then today for the SNB? What does that mean for Swiss banks, and what else do we have to watch for when it comes to the commentary from the SNB?
Well, the thing is, you don't see a lot of zero interest rates around the world. It's a rate level which hasn't really been tested. Particularly, it has never been in place in Switzerland. The SNB has crossed the mark twice. They went into the negative back in 2014 and came out in 2022 again. However, both times they skipped the rate of zero. They avoided setting the interest rate at zero. And the reason for that is that an interest rate of zero hits banks on both sides of the balance sheet. So on one hand, it eliminates the income they gain from deposits, and on the other side, it also compresses the margins they can make on loans and mortgages. So actually, like if you talk to bank analysts, they say it's a worst case scenario. Like banks like interest rates of zero even less than they like negative interest rates. So we'll see if the SNB policymakers will take this into account and might skip zero again.
Okay, well, talking about pressure on the banks, UBS obviously in focus when we talk about 0% interest rates and the impact there. But the S&P has been talking about UBS today. What have they been saying?
Well, they published their annual financial stability review this morning, and they have said, the capital reforms which the Swiss government envisions are absolutely bearable for the bank. For this, you have to know a little bit of context. So since UBS took over Credit Suisse, in 2023, there has been this massive undertaking of revamping Swiss financial regulation, because obviously like a crisis like this can't happen. This is very much the view in Switzerland. And so they have started to revamp Swiss financial regulation, because UBS, after the absorption of its former rival, it has now a balance sheet which is twice the size of the Swiss economy. And to make the bank more stable, they have said, okay, you need to back the entire capital in your foreign units with capital at the parent bank, which is based here in Zurich. And that could see a capital hit, could force UBS to increase its CET1 capital by as much as $26 billion. So that's quite a bit. However, the SNB, who has argued for this move before the government came out with it, has said, okay, you can actually do this without excessively curtailing investor payouts and also without raising new capital.
Okay, Bloomberg's Swiss economy reporter Bastian Benrath. Right, thank you very much indeed, with a preview of the SNB and what they've been saying as well about the capital requirements and the balance sheet of UBS. Now, some other stories making news this Thursday. Staying on the banking space, Barclays and Santander are said to be among the lenders interested in buying Banco Sabadell's British unit, TSB. Sources tell Bloomberg that banks are in the early stages of exploring separate bids for TSB. Sabadell confirmed this week it had received expressions of interest and would consider offers for the business it's owned for 10 years. UK consumer confidence jumped to its highest level this year, boosted by rising optimism among Generation Z, or Z, after the latest increase in the minimum wage. It marks the second consecutive improvement in the confidence tracker from the British Retail Consortium. The figures may add to hopes that households will loosen their purse strings after historically high saving rates in recent years. And the number of London homes for sale at £5 million or more rose to the highest on record last month. According to data from researcher Lonres, there was a 22% year-on-year jump in top-end homes on the market as the UK contends with the departure of wealthy foreigners looking to escape tax hikes. But those looking to sell their luxury homes are also facing a slump in demand. Lonres say price reductions have soared this year compared to the same period last year. Coming up, the head of the International Atomic Energy Agency says Iran's nuclear power plants should never be targeted in military strikes. We have more on that. This is Bloomberg.
what is particularly challenging right now is some of the jamming that's happening on GPS devices and the like, which is a concern. The Straits of Hormuz is, at the end of the day, the artery through which the world's energy is flowing.
OK, the Shell CEO on the current challenges of shipping oil through the Strait of Hormuz. Let's get you more details in terms of the conflict as, of course, we wait President Trump's decision as to whether or not to involve the US militarily against Iran. Some lines crossing in terms of Israel's latest strikes on a heavy water reactor, the Kondab nuclear site. This is according to Iranian state television, saying that 2 Israeli missiles hit the nuclear facility at around 6 a.m. local time, causing, quote, no serious damage or radiation risk. That, again, is according to Iranian state television as Israel continues its attacks on the nuclear facilities of Iran. The head of the International Atomic Energy Agency, meanwhile, says that Iran's nuclear power plants should never be targeted in military strikes. Director General Rafael Grossi also told us the UN agency has found no concrete evidence that Iran is actively pursuing a nuclear weapon.
No country in the world is enriching uranium at this level of 60%, which is technically almost equivalent of 90%, which is needed to have a nuclear weapon. At the same time, we are inspectors. We are not political analysts or national political officials. So we have to have concrete proof in order to say that there is an active program to make a nuclear weapon, which we have not seen. That doesn't mean that they are in a territory which is of concern. And this is the reason why there is international concern, why I had a very, I would say, serious report that I presented, as you may know, to the Board of Governors of the IAEA a few days ago.
Director General, there's a real question about what type of nuclear risk there is should there be some sort of explosion at some of these facilities. I know you've been directing a number of studies on this. What have you detected so far, and how concerned are you that a direct strike on Fordo in particular could release nuclear material into the environment?
If only a part of it is affected or more. But certainly the possibility of a radiological impact, environmental impact exists. And as you also know, there are other facilities, including a nuclear power plant in Iran, which of course should never be touched, because this could be another level of concern and environmental damage. So this is what we see at the moment.
Director General, this is one reason why some people have speculated that there has been hesitance by Israelis as well as by the United States of truly dropping some of the bunker bombers and other types of military equipment to try to destroy some of this weaponry. Do you think that this is actually a real risk, the sort of release potentially of radiological material into the environment that you think people are taking seriously? Have you had conversations with the U.S. or Israel?
Well, we have reminded everyone, not that we need to be honest, because I think in the United States, you are the leading country in nuclear science and technology in the world. So I think there is complete awareness, and also in Israel and in Iran and in the region and in Europe. I'm talking to, and I would say in the Gulf states, I'm getting lots of calls from high officials, ministers, prime ministers. They are all very, very concerned about this probability. And I think, of course, I'm a diplomat. I'm not privy to military decision making. But I want to believe, and I think this should be the case, that the potential radiological consequences of any military action is well taken into account. What is important is to return to the diplomatic table as soon as possible, because what is at stake is very serious.
IAEA Director General Rafael Grossi speaking to our US colleagues. There's plenty more coming up. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. So the Fed's staying on hold as expected for the fourth straight time. Markets still pricing in 2 cuts this year, and that aligns with the dot plots or the forecasts from the members of the FOMC. Though if you lift the hood, you see the divisions there. 7 members of the FOMC see no cuts at all this year, while 10 see 2 or potentially more. So splits and divisions with the FOMC, reminding us of the uncertainty. Where there isn't uncertainty, at least according to Jay Powell, is that prices will go up for consumers as a result of tariffs. The inflation forecast revised higher. The growth forecast for the US from the Fed revised lower. So that is the Fed and that is the pricing. Let's flip the board and check in on the BOE, because that decision comes through later today and it is a complex picture for the Bank of England. I really wanted to focus in on the labour market and a reminder of the softness that we've seen in the month of May, the biggest drop in jobs in the UK since the pandemic. 250,000 jobs have been lost since Rachel Reeves, the Chancellor's budget of October. So the labour market here is softening. The data that has come through since the last meeting of the Bank of England has shown that growth as well continues to stumble in the UK, and yet prices remain sticky, and that is the conundrum. But the labour market is softening in the UK. Worth bearing in mind as we head up to the Bank of England decision. Again, they're expected to remain on hold at 4.25%. Let's quickly check in on another story, partly linked to central banks. Stablecoin legislation is working its way through the US. This, of course, is a digital asset underpinned and linked in the US to the US dollar. And there is pressure on Visa and MasterCard. A sell-off yesterday. Why? Because some multinational companies, according to reporting from the Wall Street Journal, are looking at using stablecoins to get around Visa and MasterCard. So potentially some big changes for those credit card providers. There's plenty more coming up. Reminder, tomorrow, Bloomberg Tech Europe debuts at 6:30 a.m. UK time on Bloomberg Television. The opening trade is up next. This is Bloomberg.